All right, party people. Party people, party people. Welcome to the Quant Data Q&A, the Sunday edition. Some fun, exciting things happening today for sure. We run these Q&As every Wednesday and Sunday, 5 p.m. for the Quant Data community. Absolutely free for everyone, right? We also go through some of these lessons. So today we are going to go through chapter 3. We're going to talk a little bit about volatility, talk a little bit about strike width, right? And the reason as to why we do what we do during each environment. As traders, we must know. As traders, we must know when it's time for us to use what strategy, when it's time for us to, risk off, when it's time for us to be risk on. A lot of us options traders, a lot of us spreaders, right? A lot of us guys who like to trade options spreads. Obviously, you guys know that's my primary bread and butter. We focus a lot on the environment of the volatility, right? Because that is going to tell us what we need to do, how we should be trading the market, and how we should be managing ourselves in our portfolio and our risks, right? So today we're going to talk a little about volatility. We're talking a little about strike width. I put a little hint there at the bottom called IV plus or minus 30%. That is kind of my personal rule of thumb. Of course, I've taken this from other volatility studies. I've taken this from other traders. And of course, Tasty Trade has taught me a hell of a lot. So shout out to them. And shout out to other sell-side guys here in the chat too, like Freddie, Amit, Valkyrie. Those guys I've learned so much from. And of course, the king of the goats, the top goat, D for D, right? He's number one in terms of sell-side and teaching us things. Now, obviously, he doesn't like zero DTs too much, but we are going to talk about it nonetheless, right? So, chapter 3, volatility and strike width. Keep an eye on this. We might reference this a little bit. So this is just a little short presentation. So first thing I want to say is, this is something that we all know. Who agrees with this? Volatility is the only instrument that mean reverts. Now there has been some arguments made on this, but we gonna show you today as to why this is mostly true. This is mostly true. Okay, so volatility is the only instrument that mean reverts in most cases. Implied volatility is the measure of deviations from the equilibrium or stable price. So the mean, the middle price, the price it's at usually, right? Because of its nature in measuring deviations, it is one of the only instruments that we can truly say mean reverts. Now there's a trick question down there. It's another popular tool that also deals in deviations. We're going to ask that in a little bit, but let me show you really quick, right? So some people will argue that, SPX, mean reverts for sure. SPY, does it really? Take a look. This is SPX today. This is your SPX. We're going to remove the sides. Tell me where it mean reverts. Just remember this picture right now. Yes, it comes back down. Right, maybe there's a line that goes forever to the up, but if we look at the SPX, right, we look at an ETF like the SPX and SPY, QQQ, it's all going to be the same. Generally, it just goes up and to the right, to the right and up. This is why we know selling puts in any market environment is generally acceptable, because we don't really dip down that much further, right? This is what it does. This is all it does. Just continues going forever to the moon. Okay? So remember this, right? This chart right here? Yes. Can we say that this mean reverts? I don't know. Up to you. It's always that debate, right? Let's look at the VIX. Kablam. What do we see? Big difference, right? Big difference. Does this look like it has a mean? Does this look like it has generally a floor and a ceiling? What do we think? What do we think, boys and men? What do we think? and girls, if there's any females here. Oh, there's one. There's one. Oh, Hodler's not here. No, I'm kidding. Yeah, right, so the VIX, right? So when we go back to what we're talking about here, volatility is the only instrument that mean reverts. We can say visually, yes, it does have a ceiling. It's 89, right? I'm sure it's gone to VIX Mageddon, right? If I go all the way back there, but it does have a floor, right? It's like right around this area, the 20 to 14 area. We can kind of say 12, right? Back when we were kind of like a bull rally, right? We had VIX at 12, 13 most days, and then just kind of chilled, right? Very different than SPX. So this, just visually, we can say that this does have a floor. It does have a kind of, if you map a band out on this, you can see that it goes up and then it comes right back down, right? So when we talk about, right, when I draw out the VIX, when we teach each other or teach you guys in the stream about the VIX and volatility and what we're supposed to be doing, well, this is kind of what we're looking for, right? Like when I draw this out, this little teepee, it does look exactly like this, doesn't it? It's the same, right? So we can say truly that this is the only one. And so what it measures, of course, is how far we are going beyond, how far we're going beyond the mean, the stable price. Right now we can run some calculations and say what it is. It's going to change every time. But we can say that right now at 20, we're kind of a little bit higher, right? We're starting to elevate a little bit. So the trick question, another popular tool that you can also deal in deviations. I'm going to leave that alone for now. I'm going to skip this, and then maybe we use this question for giving something away later, right? So we just looked at SPX and VIX. We did that earlier. We can see that SPY, SPX generally goes up and to the right, and VIX is the only one that can track. But we use VIX and IV to determine how we should be trading the market, right? Now, you've seen me share this before. Being on the right side of volatility is important, right? Personally, we use the 30% rule of thumb, right? So whenever IV is above 30%, right, we want to be more so looking to sell options into the market. And whenever IV is low, you can still sell, right? You can still sell options. You just have to trade it a little bit differently. I'm going to show you what the difference is. But generally, you're a buyer when IV is low. When IV is low and we're not looking for a lot of price movement, there's not a lot of extrinsic value to get out of the options market. We're looking to buy options. Okay, more so like debit, right? Debiting. When we're selling options, right? When we're doing spreads, we have to remember that we're looking to capitalize on extrinsic value. So a quick trick question here. Not really a trick, but what is the one factor, the one thing that increases extrinsic value in the options contracts the most? What would it be? It's something we're talking about right now. What would it be, chat? I'm not going to skip this one. I'll let you guys answer this one right now. IBE. Volatility. That's right. Volatility is the one data point. I'd say. I don't know what's the proper word, but it's the one thing that increases the extrinsic value of the options contracts the most by far. By far. We're going to relate back to this shortly here. Call it a variable. Yes, that's perfect, Valkyrie. Thank you very much. It is a variable. So in a low IV environment, when IV is low, we're kind of stuck selling closer to current prices, right? Because when IV is low, what does it mean? There's not that much extrinsic value for us to capitalize on. So when we're trading spreads in an IV low environment, what should we be doing? There's 3 things that I've labeled it here. I'm going to give you the answers in a little bit, right? But it should be fairly obvious. We're not looking to capture a lot of extrinsic value because we can't. So we're only looking for generally the underlying price to kind of move in our favor. That's how we're going to make money. But in an IV low environment, we also want to minimize our risk because there is a chance of something we talk a lot about in the stream. It's a chance of an IV bloom, right? So what is an IV bloom? It's when the VIX does something like this, right? When all of a sudden we are, we're at this floor and then we get this huge wave up, right? This is what we're at risk of when we're selling spreads in a low IV environment. So what is something we can do as traders selling spreads into the market in a low IV environment to reduce our risk? What is something we can do to reduce our max loss potential, right? You're basically trading spreads in a low IV environment in a directional sense, but you're still allowing the market to pay you for that risk. Right? So what we can do is reduce our strike width. So it goes directly to what we're talking about, strike width. So number 2, right? IV low, right? When IV is low, we want to decrease max loss risk by reducing the wingspans of our credit spreads, right? So 5 wide generally. This is kind of why I do 5 wides during times when we're below 30%. And that also helps us by staying away from the potential of IV bloom, because when an IV all of a sudden happens, when we get an IV blooming kind of scenario, we get huge moves, huge fluctuations that could blow right past us on our spreads, right? 5 wide meaning from 5 bit. No, so I'm talking about if I'm selling SPX spreads, right? If I go to SPX, let's see, SPX, and I go options chain, do vertical spread, right? So this is I think this is the 24-hour one right now, right? August 4th. Okay, yeah, so there's things going on right now, but I can't, actually, let's not do this. Let's do August 6th, because things are kind of stable on August 6th. I can reduce my risk by doing this, right? Only 5, because at a 5 wide, I can only lose a maximum of $500. That is my maximum risk in the market. If I do 10, I can, for every dollar wide your strike is, it is $100 of risk, right? So make sure you understand that part. But we reduce it because there's not a lot of extrinsic value and we are at risk of an IV blooming scenario. Again, when we are IV low, technically we should be looking to buy. But that doesn't mean you can't sell. You can still sell. You just have to make sure you protect yourself at all times. So this is what I'm talking about, 5 wide. Now, if we start doing 10 wide, right, when IV is well above 30%, you can see that it's not really, right? You don't really get that much more for doing so. So, right, decreasing max loss risk, stay away from potential IV bloom, because that could happen, right? We're on the opposite. We're on the floor of IV. So capitalize mostly from a directional underlying delta K, right? What does that mean? We know that based on this picture, right? Based on IV, correct? We can go like this. This is what it does, right? It mean reverts, right? So when we start selling at a time like this, we are at risk of price doing this, IV bloom, and then we're in trouble. Right? So because this isn't pricing in the options contracts that much, when we're selling here, we're really just banking on price moving directionally, right? Now again, it does still decay, but it's just not as rapid, because we can see that when we're at the top of this hill, we have this to capture. This always happens. This is more guaranteed than this going up. When IV is low, we don't know when IV is going to go up, right? But we know when IV is high, there is an absolute guarantee that IV will revert back down to its mean. So when we start selling in these areas, when IV is high, that's when we want to be more risk on, because we know that this is absolutely going to happen. We just don't know. Timing this is a lot harder than timing this. Does everyone understand that so far? Yes, Gamma Man, 100%. What you're asking right now, it does. That is true. Chriselle, I'm going to answer that one later, because that one's a lot longer. A lot longer of a question. Perfect. Perfect. So when there's not much extrinsic value to get, we're really depending on a directional move especially because we're selling so close to current price. Right? So because of an IV low environment, IV theta decay is not rapid. Therefore, when selling spreads in a low IV environment, you're banking on being right directionally, but you're ensuring that you cap off your max loss risk. So that's my last little note there. Okay. IV high. So when IV is high, we are given the opportunity to sell very far away from current price, as there's much extrinsic value in the options contracts. Right? Refer to VIX drops. That's my little note there. So I'm going to refer you guys to the VIX drops. So take a look at the VIX. Okay? We're going to do it on a daily. We're going to do it on a daily. So what do we see here? Right? Let's say we go to VIX like this day. Right? Oh, this is the day that I this is the day that I vomited. What is this? Who remembers what this is? August of 2024. Yen carry trade, right? But you can see, right? What happens when we get here? Is this a complete collapse? Like it falls really fast, right? But when we're down here in these environments, right? When we're down here, like look how long it took us before we had this huge bloom, right? This goes right back to what I said. It's easier for you to predict when the volatility contracts than versus you predicting when volatility is going to bloom, right? But there are some hints, and I'm going to show you with quant data some of the hints that we can have, that we get utilizing our tool to see where the VIX is or what the VIX is going to do. But you can see, right, it spikes up all the way high, right? That is when we know, okay, we should be starting to we should start to sell and widen our wings to increase our risk, because IV's at a crazy high. It should drop, right? So we saw that. It went to 65. It dropped literally the next day to nothing. It dropped the next day to 30. That's half, right? That's crazy, okay? So this allows us to capture more when we sell spreads. Sometimes we can sell from the open to ST. You guys have seen this before when volatility is very high. You know that when volatility is like above the 30s, sometimes into the 40s, that as soon as we open the day, what can we do? We can use standard deviations. We'll go through that another day, but we can calculate up to 2 standard deviations and sell premium all the way there, knowing that there's likely an 80% chance that we're probably not going to get there, right? Traders often expand their wings when IV is high, especially on credit spreaders, right? So we have 1, 2, 3 scenarios. I'm going to quickly just share it now. Higher value selling contracts because of increased extrinsic value, right? The wider the wings as well, the faster the decay between contracts. So here's a note for you. The further the out of the money your contracts are, the faster the decay. Right? So the further the out of the money your contracts are, the faster the decay that you experience. So this is why when IV is high, when IV gives us that opportunity to sell so much further, we want to take those opportunities because we know that our probability of profit is faster. So because of the faster decay, our probability of profit for 50%, right? Say you sell something for $1 and you're only looking to buy it back at 50 cents. When IV is above 30%, you actually have a higher probability of closing it at 50% purely based on volatility contracting. And it is increased by 33%. Increased by 33%. Okay, so we're going to go on now. When IV is low, we must focus more on the gamma. So why do you guys think that is? Why do we focus more on the gamma when IV is low? Hargan, yes, 100%. What you're saying right there is 100% true. 100%. When IV is high, everything decays a lot faster than mid to low. Yes, because when low environments, we're just banking on regular delta decay, which is a lot slower, right? That rubber banding effect of VIX, right? That's what we want to capture as when we sell spreads. So I'm I'm going to delete this really quick. Let me see this. So let's do, so this is gamma, this is delta. We're going to do July 17th, my favorite day. Why not? Right, that's right. So in a low IV environment, we focus more on gamma because gamma would be a magnet due to the fact that volatility isn't much of a factor in this environment. All right, our strategy persists. We look to sell beyond the MVC and towards the direction of the MVC, right? MVC showcase, it would be right here, right? It would be right here. This is what we're kind of looking at, right? You want to see you're selling puts and then you're just going to sell calls beyond 6,300 because based on gamma blooming, right? The gamma effect, gamma expansion is something we call, right? We're not going to look, we're not likely to surpass the 6,300. But when IV is high, which one do you think we should be focusing more on? Which one should we be focused more on when IV is very high? In terms of the Greeks, what do y'all think? Which of the Greeks directly relate to volatility? Vanna, that's right. Everyone knows it. Oh man, you guys are so smart. You guys are so smart there. Quick question: is MVC the most expensive or most likely to profit? It is the MVC for gamma is the hedging requirements of dealers. So it is technically an obligation. We can dig into that more next time. That will take me a lot longer to explain, and I don't think I'm going to make it through that in today's session. But if you are really curious, just on Tasty Trade and on Investopedia, they have a really good article on what gamma represents. And if you can't find the link, just DM me later. I will send you that link because I have it in my notebooks. Let's take a sip of water here. Sorry. So we're going to go further now to this one. So when IV is high, Vanna is the Greek we should be focusing on because Vanna being directly related to volatility, we must focus on this Greek during high IV environments as Vanna would greatly affect the sensitivity of delta, therefore the premium. So the strategy for this day is going to change a little bit, right? We should be selling beyond the Vanna points because, well, of course, it is the most sensitive during IV because IV weighs it a lot more. So this curve that I've shown y'all before, my little NFT, right? Who remembers this NFT? Who remembers this little NFT? Oh, sorry. Let me drag this a bit. Who remembers this NFT? Y'all know it? Right? So does this change then? Does this change when IV's high? Yes. The answer is yes. 100%, Brian. 100%. It is yes. Because the weighting should change. What doesn't change is actually the last bit. The last session still, as time dwindles to nothing, right? During the last 2 hours of the day, this part would still remain. But when an IV higher environment, we would actually see Vex hold above gamma for a lot longer. Nonetheless, it is still true that gamma in its nature can bloom to infinity as contracts become in the money. And volatility, Vanna, is still going to be an extrinsic value factor for the options premiums. Does anyone understand what I'm saying there? Right? Gamma can, in the end, become intrinsic value, whereas Vanna can never, in the end, become intrinsic value. It can only ever be extrinsic. So the last session here still remains. It's just that this curve would look very different. I may redraw this NFT and then sell it to you guys for like, a couple of dollars. A little bit of coffee money, right? I deserve some money too. So what about during FOMC? FOMC, we're still going to be doing the same thing. You still generally want to be looking at the generally still want to be looking at the IV on the individual time series, right? So the IV here, you still generally want to be looking at this, right? Those market events, 3-star market events like FOMC or any sort of earnings like that, it's going to eclipse everything anyways, right? So I wouldn't assume that any individual Greek is going to help you during those events. So that's my little answer to you, Darwinist. Okay, perfect. All right, so that's it. That's all I have so far. Next time we're gonna go over a little bit more. I'm gonna choose what the topic is gonna be, but I think hopefully you guys learned a little bit of something today. Hopefully you guys learned something about the Greeks and stuff. Who is excited for the merch? Who's excited for the merch that we just dropped? I'm gonna stop the recording for YouTube. Just my last words for YouTube there. If you like what you see, like what we do, come along the community. We trade live every day in New York session. And of course, comment, like, and subscribe, man. It really helps the algorithm. The YouTube gods favor those kind of things. So thank you. I'm going to stop the recording.